Hello friends, this is Vijay Bambwani. Welcome to my weekly market outlook video. Last week, we basically shared one more indicator with you, the lift, weight, thrust, drag indicator. And thank you so much for your overwhelming response, especially all the messages on social media, on WhatsApp, etc. I truly appreciate it. And I assure you, my services are and will remain free in the public domain. I'll basically open the doors wider and more often about the studies that we formulate in our in-house statistical model, the IBEX. Friends, like I reminded you earlier, my videos are now since 3 weeks, a fortnight actually, divided into chapters. If you run your mouse over the time slider, and you will see the names of the chapters which basically tell you which topic is being covered in that particular chapter. Since these videos are somewhat longer than average, you may choose to see the chapter that interests you the most, and you can skip some parts of the video if you don't feel like watching that segment of the market. Let's proceed on to the market front, where we saw, as you can see on your weekly market roundup window, that the week was a trend determining one. Note from the market roundup how both the indices fell, with the Bank Nifty taking it on the chin. The reasons are obvious. To my veteran friends who've been watching my videos since many weeks, the rising inflation, the threat perception of rising cost of funds, and a firm United States dollar index kept the pressure on emerging markets, including India. But the fact that bullion rose in spite of a rising dollar to multi-month highs tells you that risk appetite is down a few notches, because bullion is a safe haven, and when bullion is being bought, traders are not really very gung-ho on financial assets. Oil cooled off a little bit, as I have been posting both on my social media accounts and in my media columns that I don't subscribe to the super cycle hypothesis in crude oil. Natural gas rose due to Eastern European geopolitics, and for months I've been leading the market far ahead of the curve in advocating that natural gas has now become a bargaining chip on the geopolitical stage, and basically the Russians will use it to arm twist Europe into giving up Ukraine or demands for Ukraine to join the European Union. The rupee strengthened against the US dollar, which cushioned the fall in the equity markets, which would have otherwise been far sharper. And watch the currency peg, especially after March end, because that will tell you where our markets are heading over a period of time. The 10-year benchmark bond yield eased as the absence of rate hikes saw money flow back into the safety of sovereign guarantee. Bonds are a big boys club, and big money first seeks safety and then it seeks alpha. Alpha is pure profit or capital appreciation. Once you figure this out for yourself, you've got 50% of the bond convexity figured out for yourself also. Now, the NSE market capitalization fell yet again. Do remember what I told you in my video a fortnight ago? Empirical evidence suggests any sustained declines of over 4% on a week-on-week basis leads to sharp falls in the markets. So far, the decline has been more like a slow poison rather than a crashing house of cards. The MWPL chart on your screen shows a marginal rise, and two things stand out immediately as soon as you see this chart. One is the rise has come on a week-on-week basis in spite of declines in the market, which hints of shorts getting piled up. And the other is that the MWPL has abandoned the levels that it used to see of 32 to 35% only as recently as November and December of 2021. Risk appetite, as I explained to you in the one marshmallow versus the two marshmallow theory hypothesis video, which you can see on your screen, the risk appetite is clearly shrunk because the two marshmallow guys are holding back their money. Don't worry about the hyperlinks. They are there up on the top right hand side corner, as well as in the description segment below the video. And at the end of this video, you will get an end screen to the links to both these videos. Now the markets are being propped up by the one marshmallow guys, and I'm not too comfortable with that. The index and stock futures volumes chart on your screen shows the index turnover fell on a week-on-week basis, whereas stock futures turnover rose. Now this is exactly what I was telling you about. The one marshmallow guys are active. Now traders are taking a high-risk route to derivative trading because they are shunning the index, which is relatively less volatile, in favor of stock futures. Because intraday statistical beta of individual stock futures is at least 2x or 2 times higher than index futures, ballpark. Now watch this space keenly because I cover both these aspects, both the MWPL and the turnover on my social media accounts, as you can see on your screen, on an end of the day basis every day. So do connect with me and get yourself updated so that you're up to speed in the markets. Now let's check out the basis chart, which is showing on your screen. It is drawing, not only drawing, but it's actually demanding your attention. The Bank Nifty futures are in inversion zone, which means the future is trading at a discount to cash. And that means that traders are willing to short sell the Bank Nifty even at a tiny discount to cash. Usually, they would sell at a premium, which would decay towards the expiry, which happens to be after 4 sessions, which gives them an added zing for their money. But here, they are willing to sell at a discount, which means that they are willing to risk the fact that prices will go back to the zero level or convergence towards spot, which means their profits might be eroded a bit, but in spite of that, they're still shorting. The two marshmallow selling is actually taking place here. Let's take a look at the Nifty, where the basis managed to stay just above water after seeing inversion for 3 out of 5 trading sessions. That itself is not really a great thing to happen. Does it necessarily mean a crash? Well, while the weight of evidence does suggest that a fall could be likely, please note that the coming week is not really your run-of-the-mill week. It's an expiry week. And some short covering on those open trades may be seen, which means that there could be higher volatility in the week. Now, basis is another study which I share on my social media, as you can see on your screen. So please do connect with me for latest updates. My contact coordinates will come at the fag end of the video, as well as you can see them here online. Now I'm adding another simple study this week, the advance decline ratio. As the name suggests, it's a very simple ratio of the number of rising stocks vis-a-vis the number of losing ones. It's a simple weathercock that tells me which way the winds are blowing. Only on 2 out of 5 trading sessions did I see the advance decline ratio above 1. 1 meaning for every gainer there is a loser. So if it is above 1, that means the number of gainers are higher, the number of losers are lower. Now, on balance 3 days, the number of stocks rising was less than half the number of stocks falling. That's not really very good news now, is there? The broader markets are clearly selling off. Now, let's see the impetus indicator, which you have learnt to respect and depend on so much. Now, it still suggests a falling reading on the chart. Falling, I mean the impetus reading. Last week, I warned you that when impetus falls sustainably, that means the velocity. Impetus, in this case, it's my in-house study, and there's an amalgam of a lot of inputs going in there. It's not just the rate of change or velocity, but there's a lot of stuff that has gone into this impetus indicator. So when it is going down, it does not merely mean that velocity or the acceleration is waning. It also means that the market is compressing itself like a spring. And once you let go of the compression, it'll basically spring back again. That means a very violent move in either direction. That's something that we saw on Monday last week. And last week's video also, I warned you of similar action, and look at what happened on Monday. Now, these kind of small impetus readings basically morphing into very high explosive moves in the market is likely to get more and more often. It's likely to get more and more frequent, which means you as traders will have to be more careful. Price action will be substantial, sudden and brutal, and I want my friends to take adequate precaution and trade light with stop losses. Now, for the latest study that I shared with you on Friday, the lift, weight, thrust, drag indicator, as you can see on your screen, that's the thumbnail of the video. Here again, don't worry. The hyperlink to the video is on your top right hand side. If you click on the eye, you'll get a drop down link to that video, as well as it's in the description segment below the video itself. Now, there are four phases in the market: lift, weight, thrust, and drag, which I had explained in that video. The current reading that you are seeing on your screen is both the Nifty as well as the lift, weight, thrust, drag is negative. Now, if you remember the tutorial video well, the markets are in the weight phase. Weight means wazan, something that pulls you down towards gravity. Now, because the readings are negative but not really large enough, they're below 1 negative. That means the fall, like I mentioned earlier, can be more like a slow poison than a waterfall. However, do note that the geopolitical situation can escalate anytime, and another reason why you should be trading light. Now, this lift, weight, drag, thrust, drag indicator has to be updated on a day-to-day basis unless specified. I could make it weekly and then show it to you on a week-on-week basis, which I will do in the coming weeks. I'll show you daily and weekly views. But for now, since you're getting used to a new indicator, I'm basically opening the door slightly and progressively wider. So how will you know what happens to this indicator? Hey, I promised you it would be free, and free it will remain. I'll update it for you. I'm sorry, but I, due to intellectual property right reasons, cannot share the formula with you. But what I can do and what will do is I'll update the indicator for your benefit so that you can A, scrutinize it, B, if you think it's standing up to your test, you can profit from it. So now let's take a look at the footsteps of all the four types of traders in the markets. I've changed the chart layout a little bit. I've made fonts bigger and data labels fewer for my senior friends and watchers. Do note how the FIIs have raised their net long positions in index futures and at the same time raising their net long position in stock futures too. Now the DIIs have increased their shorts in index futures as well as stock futures. Now gets the more interesting and intriguing part, where prop traders, now these are brokers' own proprietary trades, and since they know who's buying what and selling what, they are second best to insiders. So where prop traders are concerned, they are net short in index futures, where last week they were net long. And where stock futures are concerned, they are actually unwinding their long positions. So the guys who are next best to insiders are actually surrendering their longs. Now let's see what the retail traders are doing. The retail traders basically have trickled down their index long positions to almost negligible levels. And where stock longs are concerned, their relentless unwinding continued for the third week in a row. And as I wrote in my live mint column, as well as mentioned it in my previous videos here, the retail trader is now younger, faster, smarter, and learning very, very fast. And I'm glad my younger friends are quick footed to exit from long positions when they sense winds of change and trouble on the horizon, which is extremely encouraging because their appetite to learn, adapt, and act quickly is really, really heart touching. I've been receiving a lot of feedback from my younger friends, guys who are still in college, who just gotten out of college. And believe me, if you know that I have been lecturing a lot of colleges and universities, and some of my lecture pictures are on my social media account, it makes me very happy to interact with the younger crowd, and I'm amazed at the way they've learned so much in the last 2 years from the market that it took me a decade or more to learn. So my handholding will continue. You can count on me as far as that is concerned. You have my contact coordinates. Give me a shout whenever you want. Friends, let's now go to the bond chapter. As I've told you earlier, this video is divided into chapters, and you can take a look at whichever segment that you want at ease. Now, the bond market is something I've advocated ahead of the indices and stocks for many, many years now. The reason is very simple. Bond markets finance all other asset classes. And if you don't know where the source of money is, you don't know where the money is going to impact and just how much. Now, after the RBI Monetary Policy Committee, or MPC, chose to keep interest rates unchanged, the next hike, which means will come not before April's Monetary Policy Committee meeting. Now that triggered a buyback of bonds by bankers who were earlier basically shunning those bonds. At 6.66%, the yield remains in the upper end of the range. And I had told you I've stopped laddering in the month of January in anticipation of an MPC rate hike. But with the event gone, done and dusted, with no change in interest rates, we are back to laddering yields in sovereign investments. I would like to underline the word investments, not bonds. Somebody asked me, sir, why are you investing in sovereign bonds when you say that interest rates are going to go up? Please understand, I'm using the word investment, not bonds. Both are not one and the same. So the yield flipping, which I discussed with some of you in our online chat at face-to-face, will probably occur sometime in 2023. If I'm talking of the calendar year 2023, not the financial year 2023. If my reading of the tea leaves of the bond convexity signals is anything to go by. But do note that sentiments do tend to change hour to hour because unfolding of events is something that a trader has to be completely alive and aware to. So, which is why I follow what I call a 360-degree worldview. I keep my ears to the ground for any change in political or geopolitical events in the world which might impact my trades. So whether it's the latest guitar riff in the United States, or the release of the latest hottest rap number in Europe, or 40-year high inflation in America, we traders must be interested in all of these as if our life depended on it with equal attention. We are brain warriors who fight and win with our heads, so keep noting everything indeed. The other aspect is that SBI raised its interest rates by 10 basis points with effect from 15th of February 2022 on long tenure fixed deposits. This validates my hypothesis of many months that cost of funds will edge higher gradually. It's not a question of if, but it's a question of when. Friends, let me remind you about a month and a half ago rather, Bajaj Finance, HDFC Limited, I'm talking of the housing finance firm, SBI, HDFC Bank, etc., also raised their interest rates by 10 basis points. It will basically happen in bits and pieces. It's not going to come all at one shot. That much I can assure you. So, cost of funds is slowly but surely rising, and with that, equity markets will slowly but surely face pressure. Both are inversely related. For those of my younger friends who are cutting their teeth in the market, do note that the cost of money is all important. So let's now go to the United Dollar Index chapter. And in this chapter, I'll talk of the US dollar index, which continued to trade firm on fresh buying. Now, note how the price is trending nicely along the bullish trend line, which I have been sharing with you since the last few weeks. The price rallied on 3 out of 5 trading sessions and closed above its 25-day exponential moving average, which is a proxy for a month-long holding on cost of an average trader, which means the short-term outlook is more or less okay for now. Moving to the weekly chart, I see a long leg doji where the close and open are in close proximity to each other and both are in the center somewhat of the weekly range. This shows indecision, and follow-up action is usually required to determine the near-term trend unfolding. The 97.5 level is a stiff combat area between the bulls and the bears, whereas the 95.25 seems to be established and activated as a support area. Last week, I advocated a range between 97.25 on the upside and 94.80 on the downside, which held very well in spite of all the geopolitical drama. The coming week, I expect to see an estimated range between 97.25, which is unchanged almost, and 94.95, which also is pretty much unchanged because the intraday, the week-on-week change has hardly been anything. So the base effect is not really kicked in much. Now the price remains above its 25-week exponential moving average, which represents approximately a 6-month holding on cost of a bull. So the medium-term outlook remains positive for now. Do keep this index on your watch list because it will impact Indian commodity and forex pegs directly, and will also impact our equities and bond markets indirectly. Let no one else tell you that you should ignore this signal just because you're a pure equities alone trader. Friends, I now move to the Bank Nifty, which lost 2.38% on a week-on-week basis. It fell on 3 out of 5 trading sessions. And had it not been for the big bounce that you can see on the chart on Thursday, the week-on-week loss would have been far bigger. The price has closed below its 25-day exponential moving average, and it's still trading above the 36,500, which is more or less a sort of Maginot line for the bulls to defend. And the 25-day exponential moving average, which I told you is a month-long holding on cost, tells me that the bulls are clearly not recovering their cost of carry, which is they are under mild stress. Now that can be eliminated if the price goes above 38,500 convincingly and stays above that. Now the probability of a down move is slightly higher than an up move because I pointed out to you in the lift, weight, thrust, drag indicator that unless unforeseen good news comes in, the Monday opening is likely to be on the back foot. Let's now turn to the weekly chart and note how the last candle is a long leg doji, just like the Dixie, or a candle where the open and close are in the vicinity of each other and both are somewhat in the center of the weekly range. The previous week's candle was also a rough and ready long leg doji, just like this one. This raises the effort level which will be required by the bulls to revive bullish sentiments. Volume and open interest, which means one marshmallow and two marshmallow traders, will need to get the job done by putting in extra efforts. Whereas gravity and a little bit of short selling, on the other hand, will be enough to push prices lower in double quick time. The price is marginally above its 25-week exponential moving average, which is a 6-month holding on cost of a bull, which means the medium-term outlook remains steady, but only for now. Watch this aspect very keenly in the coming days, my friends. In the week before last, this index was at number 10 of the most volatile counters list, but it fell by one notch to number 11. It's not that the volatility of the bank nifty or the beta which has fallen, but individual stock beta which has risen faster than the bank nifty's beta. That's a big difference to a statistician. Last week, I advocated a range between 40,200 and 36,800, which was violated by 150 points because the intra-week low was 36,650 due to geopolitical factors. Now, this will continue to weigh on the markets in the week ahead too. The Jensen's measure has turned more hostile for intraday leverage traders as compared to last week, so I advocate even more lighter exposure with due diligence to stop losses. In the coming week, my friends, I expect a range between 39,300 on the upside and 35,750 on the downside. Do note how the weekly ranges are slowly but surely edging downwards. Now, I come to the Nifty 50, the most liquid and the lowest impact cost F&O traded instrument on the NSE Derivatives Exchange. Last week, it fell by 0.57%, and this broader based index fell relatively less than the Bank Nifty, which I think is a minor mercy. Had both headline indices fallen together, the declines in the mid and small cap stocks would have been even sharper. Note how the price was moving within a bearish channel between October to December. It broke out and attempted to rally. I'm using the word attempt deliberately here because the rally was abortive and it failed. And it failed to even test the October 2021 high, which tells me that a lower top formation was made. Now, the price is ensconced within a bearish triangle where tops are progressively lower, with the bottom at 16,800 to 16,850 approximately, give or take a little bit. Note how the price is sustaining below its 25-day exponential moving average throughout the triangle formation. Now, this average is a proxy for a month-long holding on cost of an average bull, which tells me that the short-term trend remains under severe pressure and bulls are unable to recover their cost of carry on buy and hold positions in this index. If carry costs are included in the mark-to-market losses of a long-only trader, the M2M loss is far higher over the 5-month tenure as it appears as compared to what it appears on the chart, because the chart does not show you cost of carry. Note that the impetus was warning of an explosive move ahead, and this is a bearish triangle. So one more point of evidence to tell you that A, there's an explosive move coming, and B, the triangle is indicating bearishness. And C, the lift weight thrust drag indicator, at least for Monday, is telling me that the market might just seek equilibrium at lower levels. So this is not really a good time to be holding on long. Actually, it sucks to be a bull right now, if you ask me. Now let's shift to the weekly chart where we see a second consecutive week of a bearish candle. The price has just about managed to close mildly above its 25-week exponential moving average, which is a 6-month holding on cost of a bull, which means the medium-term outlook is under pressure. Statistically speaking, this is the first serious correction that is setting in the market after the rally started in the end of March 2020. almost 23 months. So this is why I said the younger traders are displaying far more savvy by flipping trades, locking in gains, and getting out of positions whenever they feel any kind of threat perception. Which is also why I'm stressing repeatedly on sovereign investments with government guarantees for fixed income. Let someone else be a bull in this market and bear the risk. We, you and me, will come in at the appropriate time and basically buy when it's the right time. Last week, I advocated a range between 18,000 to 16,700, which held perfectly well in spite of all that volatility that you saw in the markets. All right. And the coming week is likely to see an expected range between 17,900 on the upside and 16,550 on the downside. Here again, notice how the range is falling progressively. Expect a breach possibly due to the global factors which are likely to deteriorate, or maybe they might even improve. There might even be a truce. So we just don't know. But to be on the safer side, what is the Jensen's measure telling you? It's telling you that hostility has just gone up as compared to the previous week. And last week itself, I told you hostility has gone up in the previous week as well. So times are not really great to be a leverage bull right now, which is why I would request you, in your own interest, to trade light, keep your stop losses in place, and don't get too aggressive. Friends, with the indices done, I now move to the most popular segment of this video, wherein I give you 5 stocks which are high beta, high impetus, where you take small exposure, wait for large price moves, and 5 stocks which are low beta, low impetus, where you take large exposure, wait for small price moves. Why the difference? Because different traders have different mindsets, attitudes, and aptitudes, and therefore their strategies and tools must differ. So, jumping in, the high beta list is led by Manappuram Finance at number 1, number 2 Cipla, number 3 NMDC, number 4 Astral, number 5 Sun TV. Low beta, low impetus stock list is led by Lupin at number 1, GNFC number 2, number 3 Godrej Properties, number 4 HDFC AMC, number 5 SBI Life. If you notice something, HDFC AMC and SBI Life are financials, and financials are basically, like I've told you, the cost of carry is likely to impact a lot of these financial sector service stocks. And also, friends, do remember that the hierarchy of high and low beta stocks is likely to change hour to hour, day to day, which is why I suggest you remain connected with me on social media, because I update a whole lot of this data in very easy, simple to understand terms for even a high school child. And you can update yourself, and we can have conversations going, help each other becoming better traders. Friends, before I sign off from this video, may I request you to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment section, good, bad, or ugly, I always welcome your feedback. Also, please help me reach out to fellow like-minded investors and traders by referring my video to your family and friends. Also, in the description below this segment is a hyperlink to my playlist on Equity Masters YouTube channel. Please do subscribe to their channel as well, wherein I put up 2 ideas every week. And there is a hyperlink to a free trading guide from Equity Master in PDF format. Do avail of this offer as well. I thank you for your patience in watching this video. Till we meet again in my next, this is Vijay Bambani signing off for now. Do take very good care of your health and trades. Take care. Bye-bye.